pulling back a little bit today as the rally hits a bit of a wall while earnings ramp up. Will earnings kill the rally, or will they be strong enough to keep it going? Our market guest expects an expansion of the rally in the year ahead. He's Kevin Mahn, President and Chief Investment Officer at Hennion and Walsh Asset Management. Kevin, always good to see you.
And you, Tyler.
So far, earnings, how would you characterize them?
I believe that the market is actually feeding off of earnings right now. Absent any Fed meetings, they're looking to digest these earnings reports to see if, in fact, the Fed's forecasted economic slowdown is going to come to fruition. I would also argue that if we have a weak earnings season, that could actually provide additional fuel to this bull market rally, because it ties into the notion that they're going to have to cut interest rates to help prevent this economic slowdown from leading into an economic recession.
But if they cut rates because they're worried about an economic slowdown,
yes,
is that good for stocks?
It ultimately is good for stocks.
Ultimately, but in the short run...
For the next 6 months, I believe there's going to be additional volatility as this pace of economic slowdown starts to set in. The Fed is forecasting economic growth to slow to 1.4% this year and stay below 2% all the way through the end of 2026. So they're going to have to step in and start cutting interest rates, but not until the second half of this year.
Let's look where we are. We're only 10% of the companies in the S&P 500 have reported so far. 62% have beat consensus expectations in terms of earnings per share. The 5-year average is 77%. So we're below that. And the consensus is that we're going to get 12% earnings growth this year. Is that too high given what we're seeing so far?
I do believe that 12% earnings growth forecast does have to come in a little bit. As it stands right now, fourth quarter S&P 500 are expected to decline, not increase, but decline by 7% year over year. That would mark the fourth quarter out of the last 5 quarters where earnings growth have declined over the last 5 years. That fits right into this notion that the economy is slowing.
Does it even matter? Because half the time, I swear, I cover earnings of a company that just knocks it out of the park. And you know what happens? The shares decline. Are investors paying attention to earnings?
They certainly weren't last year. All they were focused on was the Fed guessing game. When is the Fed going to cut interest rates? How much are they going to continue to keep interest rates at these current levels? Now they're starting to pay attention because they want to understand if this forecast for an economic slowdown is real. And it is. The next 2 quarters will mark an economic slowdown. The Fed will have to step in, and that creates the opportunities in both stocks.
But you don't see them stepping in until second half of the year, or sort of May-ish, June-ish? What?
I believe it will take 2 consecutive quarters of a slowing economy for the Fed to feel comfortable cutting interest rates. That brings us
slowing,
into the second half.
Or negative? Slowing. Not dipping into the classic definition of
not
negative.
Not into recession. If it does, they may have to step in even sooner.
Shrinkage. Let's talk a little bit about the idea that this year, to the extent that there is a rally, is going to be a rally that is broader than what we saw last year. You called it a rally of the rest.
Yes. So I believe 2024 will be an expansion of the rally from 2023, or a rally of the rest, if you will, beyond just those 7 large-cap technology stocks that accounted for 62% of the S&P 500's gain last year. But to get to that point, we do need the Fed to start cutting interest rates. We need inflation continue to moderate. And that rally is going to expand just beyond those technology stocks into areas of the markets that haven't recovered just yet.